All right, you've got your coffee, we've got the insights. Let's dive in. Today, we are really digging into tax deductions, specifically the ones that often trip people up. Business travel, meals, gifts, car expenses, all for your 2024 returns. Think of it like, finding those hidden pathways to maybe save some significant cash. Our mission. Simple, really. Cut through the IRS jargon, pull out the really important stuff, and we'll help you understand it so you potentially lower that tax bill. Practical, actionable stuff.
Exactly. And just so everyone knows, we're basing this deep dive directly on IRS Publication 463, travel, gift, and car expenses, specifically the version for 2024 returns.
Yeah.
So this isn't guesswork. It's straight from the source, stuff that can really make a difference for you this year.
Perfect. So let's start right at the beginning. What makes an expense deductible in the first place? We always hear ordinary and necessary. What's the real deal with that?
Yeah, it sounds formal, but it's actually pretty straightforward. Ordinary just means it's common and accepted in your line of work, your industry. And necessary, well, that just means it's helpful and appropriate for your business. It doesn't have to be like absolutely required or indispensable, just helpful.
Okay, helpful, not required.
Yeah.
That's a really good distinction. So who needs to pay the closest attention today? Who is this really for?
Well, primarily, this is gold for employees who incur these kinds of expenses, and definitely for sole proprietors.
Yeah.
But what's actually fascinating here, and a relief for many, is who doesn't really need to sweat the details in this publication. If you're an employee and your employer reimburses you fully for your expenses under what's called an accountable plan, we'll talk more about that, and you return any excess cash, and there's no weird code L in box 12 of your W-2, then generally you don't even need to report these expenses on your return. It's all handled.
Ah, okay. That simplifies things massively for a lot of folks.
It really does. Just keep in mind, partnerships, corporations, trusts, they have different rules. Pub 463 is mainly for individuals, employees, sole proprietors.
Right. Okay, but for those who do need to track this stuff, let's jump into a big one. Travel expenses. When the IRS talks about traveling away from home, what are they actually getting at? It's not just like driving a long way, is it?
No, not at all. Distance isn't really the key factor. It's about being away from your tax home long enough that you genuinely need to stop for sleep or rest to properly handle your work duties. We're not talking about a quick power nap in your car. It implies an overnight stay, or at least a stop long enough for substantial rest.
Okay, tax home, that sounds important. Can you break that down? Is it just where I live with my family?
Good question. No, that's a common mix-up. Your tax home is generally your regular place of business, or your main post of duty. It's the entire city or general area. Doesn't matter where your family lives. If you work in City A but live in City B, your tax home is usually City A. And if you have, say, 2 offices, then your main tax home is usually where you spend more time, do more business, or earn more income. You got to look at those factors.
Gotcha. So work location, basically.
Right. And this ties into something called the itinerant rule. If you don't really have a regular place of business and you don't have a fixed home base you return to, you might be considered an itinerant. In that case, your tax home is kind of wherever you happen to be working at the moment. And unfortunately, that means you can't deduct travel expenses because, well, you're never technically away from your tax home.
Oh, wow. Okay. Can you give an example, maybe?
Sure. Think of maybe a long-haul truck driver who sleeps in their cab and doesn't have a regular route or home base they consistently return to. They might be itinerant. Compare that to, say, a railroad conductor who leaves their home terminal, has a required overnight layover far away, and then returns. That conductor is traveling away from home. The truck driver, maybe not.
That helps clarify. Okay, what about temporary work assignments? That comes up a lot. People go somewhere else for a project.
Right, temporary assignments. This is key. If your assignment or job away from your main tax home is realistically expected to last for 1 year or less, it's considered temporary. And the good news, your tax home doesn't change. You can deduct your travel expenses while you're on that temporary gig.
Okay, 1 year or less. What if it goes longer?
Well, if the assignment becomes indefinite, meaning it's expected to last more than a year, or there's no realistic expectation it will end within a year, then that temporary location generally becomes your new tax home. And once that happens, boom, your travel expenses to that location are no longer deductible. There's a narrow exception for some federal folks investigating crimes, but for almost everyone else, that 1 year mark is the cutoff.
1 year. Got it. So assuming you are legitimately traveling away from your tax home, what kind of costs can you actually deduct? Let's get into the specifics.
Okay, so it covers your ordinary and necessary costs. Transportation's a big one, getting there and back. Airfare, train tickets, bus fare, driving your own car. Also, local transportation at your destination, taxis, ride shares, airport shuttles, that kind of thing. Even shipping costs for baggage or work samples.
What about using your own car while you're away?
Yep, deductible. You can use either the standard mileage rate or your actual car operating expenses, plus any tolls and parking fees associated with the business travel.
And then the obvious ones. Lodging, meals.
Absolutely. Lodging is deductible, and meals too, but only if your trip requires that overnight stay or substantial rest we talked about. Meals usually have that 50% limit. We'll discuss more later.
Okay. Are there any, smaller things people might miss?
Definitely. Don't forget things like dry cleaning and laundry if you're away for a while, business calls, tips related to the travel services, maybe fees for a public stenographer, or even renting a computer if you need it for work while traveling.
Wow, okay, dry cleaning. Good to know. Now, here's something I know trips people up. Paying for someone else to travel with you, like a spouse or partner. What's the rule there?
Yeah, this is a big audit flag if you get it wrong. The general rule is pretty strict. You cannot deduct travel expenses for your spouse, dependent, or any other individual traveling with you.
Even if they help out a little.
Nope. There are exceptions, but they're narrow. The person must be your bona fide employee. There must be a genuine business reason for their travel, not just yours. And they would have to be able to deduct the expenses themselves if they paid.
Mm.
So your spouse coming along to, occasionally type up some notes or attend a dinner, that almost never qualifies. Their purpose has to be essential to the business trip itself. Incidental help isn't enough.
Okay, essential business purpose. Got it. Let's circle back to meals while traveling. We mentioned the 50% limit. How do you actually figure out the amount to deduct?
Right, so meals have to be ordinary and necessary, and importantly, not lavish or extravagant. What's lavish? The IRS doesn't give a dollar amount, but think reasonable under the circumstances. And yes, that 50% limit usually applies to the cost of the meal itself. Now, you've got two main ways to track this. One, the actual cost method. Keep every single receipt for every meal. Detailed, but can yield a higher deduction sometimes. Two, the standard meal allowance. This is way simpler. The IRS sets a daily rate, the federal M&IE rate, meals and incidental expenses. For most places in the U.S. in 2024, it was around $59 or $68 per day, depending on the date. Transportation workers get a slightly higher rate, like $69 or $80.
So you just use that daily rate instead of saving receipts?
Pretty much. For the meal portion, you still need records for lodging and other expenses, of course. And there's even a simpler option, the incidental expenses only method.
Yeah.
You can claim just $5 per day for incidental expenses like tips. That $5 isn't subject to the 50% limit.
$5 a day. Okay,
Yeah.
And how do you handle the first and last days of travel? It's usually not a full day.
Good point. You usually prorate it. A common method the IRS accepts is the 3/4 rule. You claim 75% of the standard allowance on the days you depart and return. Or you can use any reasonable, consistent method.
Okay. Now, what if your trip is partly business, partly vacation? How does that affect deducting the big travel costs, like the flight?
The primary purpose test. This is crucial. If the main reason for your trip is business, you can deduct the full cost of your transportation to get to your business destination and back home. Any costs you incur at the destination for purely personal stuff, side trips, extra hotel nights for vacation, those aren't deductible. But the travel to the business location is.
But what if it's mostly a vacation?
If the trip is primarily personal, like a family vacation where you maybe squeeze in a couple of client meetings, then, the entire cost of getting there and back is generally not deductible. You can only deduct the expenses directly related to the business you conduct while you're there, maybe the taxi to that specific client meeting, or a business meal if it qualifies, but not the flight or the main hotel stay.
So really got to be honest about why you're taking the trip.
Exactly. The primary purpose is key.
What about international travel? Any special wrinkles there?
Yes, especially with allocating costs if you mix business and pleasure outside the U.S. But there are actually some helpful exceptions where a trip outside the U.S. is considered entirely for business, even if you do some personal stuff. For example, if you had no substantial control over arranging the trip, or if you were outside the U.S. for less than a week total, combining business and personal, or if less than 25% of your total time outside the U.S. was spent on personal activities, or if you can just show vacation wasn't a major consideration.
Less than a week. Okay, that's useful. So a quick trip to London for a conference, tack on a weekend, might still get the flight deducted.
Potentially, yes. Under that less than 1 week rule, you'd still only deduct lodging and meals for the business days, but the round-trip airfare could be fully deductible.
Interesting. Now this one sounds fun. Luxury water travel, cruises, ocean liners, any tax breaks there?
Fun? Maybe. But the tax rules are tight. There's a strict daily limit on what you can deduct for travel by ocean liner or cruise ship. It's capped at twice the highest federal per diem rate for lodging available for U.S. government employees at the time. For early 2024, that daily limit was around $11,128.
Wow. $1128 a day sounds like a lot.
It does, but remember, that's the maximum deduction per day for the entire cost of the cruise passage. And crucially, if meals or entertainment are stated separately on your cruise bill, they still get hit with their own limits, usually 50% for meals, 0% for entertainment, before you even apply that overall daily limit.
Ah, okay. So a $6,000 cruise doesn't mean a $6,000 deduction.
Not even close, usually. The limits really stack up. For example, if you took a 5-day cruise costing $6,200, your maximum deduction would likely be capped at 5 days times that $1,128, which is $5,640, assuming no separately stated meals or entertainment reduced it further.
Right. What about conventions? Can you deduct going to industry conventions?
Yes, you can, if attending the convention benefits your trade or business. It can't be primarily for investment purposes or political or social reasons. Got to be business related.
Are there different rules for conventions outside the U.S.?
Definitely stricter. If the convention is held outside what the IRS calls the North American area, which is actually pretty broad, includes the U.S., Canada, Mexico, U.S. territories, most Caribbean islands, you have to show the meeting is directly related to your business and that it was just as reasonable to hold it there as it would have been within the North American area.
That sounds like a higher bar.
It is. And for conventions held on cruise ships, even tighter rules. There's a specific $2,000 per person per year limit. Plus, the ship has to be U.S. registered, all ports of call must be in the U.S. or its possessions, and you need to attach detailed written statements to your tax return about the business activities.
Okay, lot the hoops for cruise conventions. Let's shift gears a bit to meals and entertainment more broadly, not just while traveling. There's a huge change recently, right? About entertainment?
Huge is right. This is critical. Since the tax law changes back in late 2017, generally, there is no deduction for entertainment expenses, period.
No deduction. So taking a client to a ball game, concert tickets,
Yeah.
golf, none of that is deductible anymore.
Correct. The cost of the entertainment activity itself, the tickets, the green fees, whatever, zero deduction.
Wow. Okay. But what about, say, buying food and drinks at the game? Is that also non-deductible?
Now that's the exception, and it's super important. Food and beverages provided during an entertainment event can still be 50% deductible, BUT. And this is a big but. They have to be purchased separately from the entertainment, or their cost has to be separately stated on the bill or invoice.
Okay, explain that. Like the baseball game example.
Exactly. You buy game tickets, not deductible. You go to the concession stand inside and buy hot dogs and sodas for you, and the client, those hot dogs and sodas are 50% deductible because you bought them separately.
What if it's like a catered suite at the game, where food is included in the suite price?
If the cost of the food and beverages is not broken out separately on the invoice for the suite, then unfortunately nothing is deductible. Not the suite cost, entertainment, and not the food, because it wasn't stated separately. Separate invoicing is absolutely key here.
Got it. So separate checks or itemized bills are crucial for food during entertainment, and even then, it's still generally that 50% limit, and meals can't be lavish or extravagant.
That's the baseline, yes. But connecting this to the bigger picture, don't forget there are important exceptions to the 50% limit for meals. These can save you real money.
Oh, like what?
Well, for instance, if your employer includes the value of meals in your wages as compensation, or as we mentioned, employee expenses reimbursed under an accountable plan, the employer gets the deduction, usually subject to 50%, but it's not your concern on your return. Also, things like company holiday parties or summer picnics for employees. Those recreational events are typically 100% deductible for the employer. Same for food offered free to the public for advertising, or meals sold by, say, a restaurant.
Okay, those make sense. Any others?
Yes, and this is a big one for certain industries. Individuals subject to the Department of Transportation's hours of service limits get a better deal.
Who's that?
Think certain airline pilots, flight crews, interstate truck and bus drivers, railroad workers, merchant mariners, people with federally regulated rest periods. For them, the deduction limit for business meals consumed while away from home on duty is 80%, not 50%.
80%. Wow, that's a significant difference for those folks.
It really is. A great tax-saving detail often missed.
Okay, let's talk about business gifts. Being generous with clients is common, but I hear the tax rules are pretty tight here too.
Very tight. The main rule is a strict $25 limit per person per year for deductible business gifts.
Just $25 per person, that seems low. Does that include like gifts to client's spouse?
It applies indirectly, too. If you give a gift to a client's spouse or family member, it's generally considered an indirect gift to the client and counts towards their $25 limit. Same if you give a gift to a company intended for specific individuals. It boils down to $25 per recipient per year.
Does that $25 include things like gift wrapping or shipping?
Usually no. Incidental costs like engraving, wrapping, insuring, and mailing the gift generally don't count towards the $25 limit, as long as they're, well, incidental. However, if the packaging itself is substantial, like a really fancy decorative box that's part of the value its cost, might have to be included.
Are there any exceptions? Things that don't count as gifts subject to the limit?
Yes, a few useful ones. Items costing $4 or less that have your business name permanently imprinted on them and that you distribute widely. Think pens, keychains, cheap tote bags. Those don't count towards the $25. Also, promotional materials intended to be used on the recipient's business premises, like signs or display racks, are not considered gifts subject to the limit.
Okay. What if something could be seen as either a gift or entertainment, like maybe tickets you give away instead of using yourself?
Good question. The rule is, if an item could arguably be either a gift or entertainment, it's generally treated as entertainment, which, as we know, may...
No deduction.
Right. The main exception here is for packaged food or beverages that you give someone for them to use later, like a holiday gift basket of food or a nice bottle of wine. That's treated as a gift, subject to the $25 limit. But taking him out for dinner is entertainment. Meal rules apply, not a gift.
Okay, gift basket equals gift, up to $25. Dinner out, meal, 50% limit usually.
Yeah.
Got it. Let's move on to transportation expenses, but this time when you're not traveling away from home overnight, just local driving for business.
Right, local transportation. This is deductible too. It includes things like driving between two different workplaces if you have more than one job, visiting clients or customers at their place of business, going to a business meeting away from your regular workplace, or, importantly, driving from your home to a temporary work location, provided you have a regular place of business to travel from.
Temporary location.
Yeah.
That 1-year rule again?
Yep. Same logic applies. If you expect to work at a location for a year or less, traveling there from home can be deductible business transportation, not commuting.
Okay, so let's be super clear. How is this different from just driving to work every day? That's commuting, right? And not deductible.
Exactly. Your normal daily commute from home to your main or regular job site and back is non-deductible commuting. Always has been. Always likely will be. Doesn't matter if you make business calls on the way, listen to work podcasts, or even have advertising plastered on your car. Home to main job, commuting, no deduction.
But there are exceptions besides the temporary workplace one.
Yes. The big one is if you have a qualifying office in your home that serves as your principal place of business for that trade or business. If your home office qualifies under the strict IRS rules, then driving from that home office to other work locations in the same business, like visiting a client, is deductible transportation. You're essentially driving from one business location, your home office, to another.
That's a key benefit for home-based businesses. Okay, so if the driving is deductible, how do you deduct the car expenses? What are the options?
Two main ways, and you really should calculate it both ways, at least the first year, to see which gives you a bigger deduction. Option 1, the standard mileage rate.
That's the cents per mile thing?
Yep. For 2024, the business rate is 67 cents per mile. You just track your business miles, multiply by the rate, and that's your deduction. Super simple. But a key, and this is crucial, if you choose the standard mileage rate, you cannot then also deduct your actual car operating costs, like gas, oil changes, insurance repairs, or depreciation for that year. The rate includes allowances for all that.
So it's one or the other per year?
Per year, correct. And there are rules about when you can choose it. For a car you own, you generally have to use the standard rate the first year you use the car for business if you want the option to switch to actual expenses later. If you start with actual expenses, including certain types of depreciation, you might be locked out of the standard rate for that car forever.
Okay. And for a leased car?
If you lease and you choose the standard mileage rate, you generally have to stick with it for the entire lease term.
All right. So what's the other option? Actual expenses.
Yeah. Right. Actual car expenses. With this method, you track and add up all the real costs of operating your car for the year. Gas, oil, repairs, tires, insurance, registration fees, licenses, garage rent, tolls, parking fees, and depreciation or lease payments.
That sounds like a lot more record keeping.
It is, but it can sometimes lead to a larger deduction, especially if you have an expensive car, high repair costs, or drive fewer miles but have high fixed costs.
And how do you handle personal use with the actual method?
You need to track your total mileage for the year and your business mileage. You calculate the percentage of business use, business miles divided by total miles. Then you can deduct that percentage of your total actual expenses.
So 60% business use means you deduct 60% of your gas, 60% of your insurance, etc.
Exactly. And 60% of your depreciation or lease payments, too.
Let's talk depreciation. That sounds complicated, but potentially a big deduction, right? Are there ways to write off a good chunk of a car's cost quickly?
Yes, depreciation can be a major tax saver for business vehicles. There are a few ways it works. First, there's the Section 179 deduction. This lets you potentially deduct all or part of the cost of qualifying business equipment, including vehicles, in the very first year you put it in service, instead of spreading it out. There are limits, of course, and the vehicle has to be used more than 50% for business. For SUVs over 6,000 pounds, there's a specific lower Section 179 limit, around $30,500 for 2024.
So you could potentially write off a big chunk up front.
Potentially, yes. Then there's also special depreciation allowance, often called bonus depreciation. For qualified property acquired after September 27, 2017, and placed in service in 2024, you could potentially take 100% bonus depreciation. This lets you deduct the entire business portion of the cost in the first year for many assets, though there are annual dollar limits specifically for passenger vehicles.
100%. Wow. So what are these dollar limits?
Right. Even with Section 179 and bonus depreciation, Congress puts annual limits on the total amount of depreciation you can claim each year for passenger automobiles. For a car placed in service in 2024, acquired after Sep 27, 2017, the maximum first-year depreciation deduction, including Section 179 and bonus, was capped at $20,400. There are limits for later years, too, which gradually decrease.
$20,400 in the first year? Still pretty significant.
It is. And remember, that limit is reduced if your business use is less than 100%. If you only use the car 70% for business, your maximum first-year limit is 70% of $20,400.
What happens if my business use drops later, say below 50%?
That's important. If your business use drops to 50% or less in any year after the first year you claimed accelerated depreciation, like MACRS, Section 179, or bonus, you generally have to switch to a slower depreciation method, straight line, for that year and all future years. Worse, you might have to recapture some of the excess depreciation you claimed in prior years. That means adding some of that previous deduction back into your income for the year the use dropped. Ouch.
Ouch, indeed. Okay, briefly, what about leasing a car? How does that work for deductions?
You deduct the business use percentage of your actual lease payments. Pretty simple. However, to prevent people from getting a better deal by leasing very expensive cars compared to buying them, due to the depreciation limits, there's something called an inclusion amount. If the fair market value of the car when you start the lease is above a certain threshold, around $62,000 for leases starting in 2024, you have to calculate this inclusion amount each year and basically reduce your deductible lease payment by that amount. It makes leasing and buying more comparable tax-wise for luxury vehicles.
Okay, a way to level the playing field. And when you finally sell or trade in a business car?
You figure out your gain or loss, just like any other asset. Your basis, cost minus depreciation claimed or allowable, compared to the selling price. If you have a gain, part or all of it might be taxed as ordinary income due to the depreciation recapture rules, especially the depreciation you claimed. If you use the standard mileage rate, remember part of that rate was depreciation, so you have to adjust your basis for that too.
Got it. Okay, we've covered what you can deduct. Now, maybe the most critical piece, record keeping. How important is it really?
It's everything, honestly. The IRS can disallow deductions, even if they were legitimate expenses. If you don't have adequate records to prove them, you cannot estimate. You need proof. It's your deduction's best friend, truly.
Okay, so what counts as adequate records? What do I actually need to keep?
You generally need two things. First, some kind of written record, an account book, a diary, a log, maybe a spreadsheet, trip sheet, something like that, kept contemporaneously. Second, you need documentary evidence for many expenses. Think receipts, paid bills, canceled checks.
So, log and receipts. Do I need a receipt for absolutely everything, like a $3 coffee?
Not necessarily for everything. There are exceptions. You generally don't need a receipt if an expense other than lodging is less than $75, or if you're using a per diem allowance under an accountable plan for meals or lodging, or for things like local transportation, where getting a receipt isn't practical, like maybe highway tolls paid with cash sometimes, though Easy Pass statements are great documentary evidence. But for lodging, you always need a receipt, regardless of cost. And for anything $75 or more, you generally need that receipt.
Okay, less than $75, no receipt needed usually, except for hotels. Good tip. What information needs to be in my records?
You need to be able to prove 5 key elements for most expenses. 1, the amount. 2, the time, date. 3, the place or description where you spent it, what it was. 4, the business purpose, why it was necessary. And 5, for gifts or entertainment-related meals, the business relationship of the person you entertained or gave the gift to.
Amount, time, place, purpose, relationship.
Got it. And you mentioned contemporaneous records. Yes, that means recorded at or near the time the expense happened. Trying to reconstruct everything a year later from memory is not considered reliable. Keeping a weekly log is generally fine. Daily is even better for things like mileage.
What if my records aren't perfect? Am I just out of luck?
Not necessarily completely out of luck, but it gets harder. If you're missing, say, just one element, like a specific receipt, but have strong corroborating evidence and your own detailed written statement, the IRS might allow it. Or in truly exceptional circumstances, like if records were destroyed in a fire, you'd reconstruct with the best proof possible. There's also a concept of sampling that can work for regular, repetitive expenses, like daily car use. If you keep detailed mileage logs for, say, the first week of every month and can show your business use pattern is consistent, that sample might be enough to substantiate your business use percentage for the whole year.
Okay, sampling might help. How long do I need to hang on to all this paper, these digital files?
The general rule is you need to keep your records for 3 years, from the date you file the tax return on which you claimed the deduction. So for a 2024 return filed in April 2025, you'd need records until April 2028. Maybe keep them a bit longer, just to be safe.
3 years. Okay, so we've kept great records. We know the rules. Where does this all go on the tax forms? Let's start with self-employed folks.
Right, for sole proprietors and independent contractors, it's pretty integrated into your business return. You'll report these expenses directly on Schedule C, Form 1040. Profit or loss from business. Farmers use Schedule F. You don't use Form 2106, which is for employees. On Schedule C, travel expenses generally go on line 24A. The deductible part of your meals goes on line 24B. Car and truck expenses using actual costs go on line 9, or if using standard mileage, it's calculated elsewhere, but affects your overall profit. Gifts are usually under other expenses on line 27A.
So it directly reduces your taxable business income right there on Schedule C.
Exactly. Straightforward.
Okay, now for employees. This is where things got really confusing after the tax law changes, right? Who can actually deduct these unreimbursed expenses anymore using Form 2106? This is super important.
It is critically important.
Yeah.
Because the answer is almost no employees can deduct these expenses currently. The Tax Cuts and Jobs Act of 2017 suspended the deduction for miscellaneous itemized expenses subject to the 2% of adjusted gross income floor. And unreimbursed employee business expenses fell into that category for most people. This suspension runs from 2018 all the way through 2025.
Suspended until 2026. So unless Congress changes things, most employees just can't deduct things like unreimbursed mileage, travel, or home office expenses.
That's the reality for most W-2 employees right now. There are only a few very specific exceptions, categories of employees who can still use Form 2106, employee business expenses.
Okay, who are they? Let's list them out clearly.
All right. The exceptions are 1. Armed Forces reservists traveling more than 100 miles from home for reserve service. 2. Qualified performing artists. They have specific income expense requirements. 3. Fee basis state or local government officials, paid fully or partly on a fee basis. 4. Employees with impairment-related work expenses. Expenses related to a disability that enables them to work.
That's it. Reservists, performing artists, certain officials, and those with impairment expenses.
That's the list.
So if you're a regular W-2 employee, say, a salesperson with unreimbursed mileage, or an office worker paying for your own supplies or home internet, you get no deduction for those expenses on your federal return right now.
Correct. No deduction on the federal return for unreimbursed employee business expenses unless you fall into one of those 4 narrow categories. This makes employer reimbursement plans much more important.
Right. So let's talk about those reimbursement plans. You mentioned accountable plans earlier. What makes a plan accountable?
Okay, an accountable plan is the best kind from an employee's tax perspective. It has to meet 3 tests. 1, business connection. The expenses must be for deductible business expenses incurred while performing services for the employer. 2, adequate accounting. You must adequately account to your employer for these expenses within a reasonable period, meaning receipts, logs, etc. 3, return excess. You must return any reimbursement or allowance amount that exceeds your actual substantiated expenses within a reasonable period.
Okay, business connection, prove it, return extra. What's the benefit?
If all 3 rules are met, The employer does not include the reimbursement amount in your wages on your Form W-2. It's treated as the employer paying their own business expense. And you, the employee, generally don't report the reimbursement or the expenses on your tax return at all. It's a wash. Clean and simple. Unless reimbursement is less than expenses and you're one of the few who can deduct the excess.
Okay, that sounds ideal. What if the plan doesn't meet those rules? A non-accountable plan.
If any of those three rules aren't met, maybe you don't have to provide proof, or you get a flat allowance you can keep, regardless of expenses, then it's a non-accountable plan. And with a non-accountable plan, the employer must include the entire reimbursement amount in your income, as wages, in Box 1 of your W-2. It's subject to income tax, Social Security, Medicare, the works.
So it's just like getting paid extra salary.
Exactly.
Right.
And then if you actually incurred business expenses, you'd have to try and deduct them yourself. But as we just discussed, most employees can't deduct them anymore. So effectively, you pay tax on the reimbursement, but get no offsetting deduction. Non-accountable plans are generally not tax efficient for employees right now.
Wow. Big difference. What about per diems or mileage allowances? How do they fit in?
Per diem daily allowances for lodging, meals, and incidentals, or standard mileage allowances for car use, are common ways for employers to reimburse under an accountable plan without requiring receipts for every little thing. As long as the allowance rate doesn't exceed the federal rates, like the M&IE rates or standard mileage rate we discussed, and you still substantiate the time, place, and business purpose of the travel or mileage to your employer, the reimbursement is typically treated as coming from an accountable plan. It simplifies the record-keeping significantly for both the employee and employer. The allowance isn't included in your W-2 income, and you don't deduct the expenses. It works smoothly.
So using those standard rates makes the accountable plan rules easier to meet.
Precisely.
Okay, this has been incredibly detailed. We've gone from ordinary and necessary all the way through travel, meals, cars, gifts, records, and reporting. It really highlights how knowing these nuances can make a difference.
Absolutely. Understanding what qualifies, what the limits are, and critically, how to document everything properly. That's not just about following rules, it's about actively managing your tax situation to get the best legal outcome.
It transforms tax prep from a chore into, well, maybe still a chore, but a potentially rewarding one. Knowing what ordinary and necessary truly means and how to prove it, that really is unlocking value.
It is. And remember that record keeping isn't just for the IRS. It helps you understand where your business money is going. It's good financial practice all around.
So the final thought for you, our listener. Now that you know more about these specific rules, especially around things like meals, entertainment, and employee deductions, what's one thing you'll track differently starting today to potentially improve your tax picture next year? What hidden value might be waiting in your records?